And welcome to Prescribing Prosperity with John and Alex Soutsos. Gentlemen, I am really excited about today's guest in the next two episodes because they touch on topics that are extremely controversial, first of all, and second, near and dear to my financial and business news reporter heart. So there's a personal reason here involved. Gentlemen, good to see you. How are you?
Good to see you too, Bill. Well, we're doing very well. Thank you.
Good to see you again, Bill.
Yeah, thanks, guys. So without further ado, let's get into controversy number one. And that has to do with this little tiny institution in America called the Fed, or the Federal Reserve, as it's more formally known. How it came to be, and there are a lot of people, including today's guest, who argue it no longer really needs to continue to be, as it were. Let me turn it over to you, Alex, on that thought.
Absolutely. Thank you, Bill. And I wanted to, first of all, just say thank you to our guest, Dr. Bob Murphy, for joining us today. I've been excited as well, Bill, ever since he agreed a couple of weeks ago to come on the podcast. I feel like I'm talking to a celebrity because I've been watching him on YouTube and listening to his old lecture. So it's actually kind of funny to sit here and actually be able to have a conversation with him myself. But Dr. Murphy is a leading American economist in the tradition of the Austrian School, who holds his PhD in economics from New York University, although we won't hold that against him. He has taught at Hillsdale College and Texas Tech, and Dr. Murphy has authored several economics books for the layperson, while his technical papers concentrate on money, banking, and capital and interest theory. So thank you, Dr. Murphy, for taking the time to join us today.
Thanks for having me, guys. Looking forward to it.
Great. Well, Dad, I think you wanted to start things off, and you wanted to get a high-level view as to the lead up to the creation of the Fed. So why don't you take over with your line of questioning?
So, Bob, in my own reading of economic history, there was a series of financial panics that took place in the latter half of the 19th century, booms and busts, and I have my views as to why they took place, but you're the scholar, and we'd like you to explain it to our audience as to why those financial panics took place. What's the general undercurrent that it was common to all of them? And let's go from that point forward.
Well, sure thing. And thanks, John. I think that's a great question to start out with, an issue to address, because as the conversation so far has alluded to, I'm going to end up making the case that we really, that the Federal Reserve has been a detriment to the American and global economy. And so in part of the case, as a member of the Austrian School of Economics, I'm going to talk about their theory of what causes the boom-bust cycle. And in modern times, a lot of people may have heard Austrians or fans of that school say, like, oh yeah, when the Federal Reserve cuts interest rates to artificially low levels, it stimulates a boom and then there's a bust. And so that raises the obvious question, well, if you guys are right, how come there were financial panics in the U.S. before the Fed? So so it's good for us to go ahead and talk about that. I'm glad you gave me the opportunity. So the big picture is, again, in the Austrian tradition, that Ludwig von Mises developed this theory of what causes the boom bust cycle in market economies. It had to do with bank credit expansion, right? So the basic theory is that the commercial banks in modern market economies have this ability to expand credit beyond just like what the deposits were, right? So you could call it fractional reserve banking. That's a term some people use. So the idea is somebody puts $1,000 in their checking account in the bank obviously just doesn't keep it in the vault. They, lend some of that out, or they make loans against it. They don't literally take it out and give it to somebody. And so because of that loose joint, there is a sense in which the total number of dollars in the US or the Canadian economy is partly determined by the decisions of the individual private commercial banks. It's not just something that the Fed or the Bank of Canada, as the central banks determine. And so that surprises some people when they hear that, but that's true. That's just a fact. Like the way economists define, for example, M1, which is a certain monetary aggregate, includes checking account balances. It's not just the pieces of paper like the actual legal tender currency, but also what do people think they have in their checking accounts. So once you realize that number is part of the money stock or the money supply, you realize, if the bank gives a loan to somebody and they don't have the pieces of paper in the vault backing that up, then the total supply of money in the economy went up. All right. So that's the idea. And then Mises argued when banks do that, when they expand credit like that, that pushes down interest rates, right? To get more loan volume going out the door, they have to lower other things equal the interest rate they charge. And then he argued that gives like a false green light to entrepreneurs to start longer investment projects than they really should, right? So in the Austrian view, prices communicate information. They have a job to do. They help coordinate things. And one of the jobs that the interest rate does is to tell entrepreneurs, this is how, like, the premium on time. And so a low interest rate means, oh yeah, go ahead and invest in a long-term project as long as you think down the road it'll pay off. The rate that you're using in your books to discount those future cash flows, if that's lower, that makes you more willing to entertain a project that requires upfront costs and revenues down the road. So the basic story is, when banks engage in credit expansion, it pushes down interest rates. Businesses start long-term projects. Everything seems bustling. That's like a boom. And then eventually the banks get cold feet. They raise rates, and then the crash happens. So that's the basic story. And then that's what Austrians think happened in the 1800s, that even though you didn't have a central bank like the Federal Reserve, there was what was called the first bank of the United States and the second bank. Andrew Jackson famously, quote, killed the second bank of the United States. But those were not central banks in any meaningful, like they couldn't even issue legal tender currency. They were just like big, important banks, but they weren't a central bank by the modern definition of that term. And so the idea was, in various periods, the banks issued more notes. They had actual bank notes at the time, and deposits to borrowers, to merchants, and so forth. Like, and the specifics would vary from crisis to crisis. Like when the railroads were big and there was a lot of construction there, a lot of banks would expand credit for that reason. But the overall, the narrative for each case in terms of like what's the systematic pattern here, the Austrians would argue, is that the banks, fueled a boom bust cycle by engaging in, credit expansion in the beginning. Interest rates were at artificially low levels, and then the bust set in. One, for people who want to read more about this, Murray Rothbard, who is was one of the leaders in the Austrian movement, like after the 1950s. His doctoral dissertation at Columbia was on the Panic of 1819. Okay, so there he just goes through that. Many people point to that as like the first modern business cycle in the U.S. history, and he tells that story and gives all the statistics and shows exactly like what happened with bank credit and so on. So that's the basic story that I would say in terms of what was going on in the 1800s. And if you're going to later blame the Fed for things, how come bad things were happening even before the Fed?
So in the 19th century, especially in the United States, with the construction of the railroads, wasn't the release of federal land part of the impetus for causing the credit expansion initially?
Yes. So with all for any of the particular instances, the standard like the template or the basic framework that the Austrians usually use to try to figure out why did this happen is that one of the necessary ingredients is the banks lending against projects, even though there isn't like genuine household saving to back it up. Like that's kind of the way to think about it, that they're making it seem like these businesses have capital to go deploy, real resources are getting directed into those channels, even though it's not like there's households that are cutting back on their consumption and freeing up the real physical resources. So that's why the problem occurs. But in each narrative or episode, there are other factors to determine, well, why was there the boom in this sector, right? So like the housing bubble in the US in the mid 2000s, that wasn't caused by railroads, of course, that was caused by, real estate construction. And so there were a lot of federal policies that sort of steered the bank credit expansion into those particular sectors. So yes, likewise, when it comes to the particular crises in the late 1800s, there were other government policies that you could, cite to explain when the banks were more liberal in their lending. Why did it get channeled to and for each thing too, the individual bankers, they're not knowingly making loans that are going to be defaulted on. Like it's the hot new thing. It's the thing that, this time is different. You know what I mean? So yes, to answer your question, there was other, certain policies by the government, not just the private banks acting on their own, that could explain, why did this, heady expansion occur just in these sectors at that time.
Right. And there was also the flow happening between Europe and America in terms of the wars that were taking place in the 19th century in Europe.
Yes, there's that as well. And then also, I should suggest when you're bringing up war, so this is probably the point to make, or the place to make this point, that I just want to make sure people understand that the U.S. monetary and banking system, from the early, when the U.S. Constitution was originally formed, up until the eve of the U.S. Civil War, which was 1861, throughout that entire period, from like the early 1790s through 1861, basically, the U.S. federal government did not issue currency, right? Like there weren't $10 bills. They were issued by the government authorities. What the U.S. dollar was defined as was a certain amount of weight of gold or silver. It was called a bimetallic standard. So it was actual gold coins that were the official lawful money of the United States. And then banks could issue paper currency like that, was a claim on that. Like it was like a claim ticket. Okay. Right. And so people, if they had notes, they'd say, oh yeah, I got a $10 bill. It actually wasn't issued by the U.S. Mint or something, or the Treasury. Instead, it was like a bank note that said, if you turn this in, we will give you a $10 gold eagle coin. Right. So that's how that worked. And so the times though when it was suspended were during wars. Right. So obviously in the Civil War, most famously, the U.S. government for the first time issued currency that there were green pieces of paper, and so they were called greenbacks. Okay, and then they suspended what was called specie redemption. So people did not have to, the issuing authorities were not obligated to redeem those pieces of paper for the gold or silver until I think it was like by 1879 they restored it or something. So yeah, that's why, like, during periods of war in the U.S. at least, that you could see large price inflation, like the price of things quoted in dollars would go up because there was more money that was printed. But still, they were on the gold standard formula. They went back to it. So, for example, from the year 1800 to 1900, the purchasing power of the U.S. dollar was roughly constant. So it would vary. It went down during the Civil War, but then recovered afterward when there was deflation, actually. So just to show people that, like, what a different system that was at the time.
Okay. So that leads us toward the end of the 19th century. What triggered the U.S. government of the day to start considering alternatives to the existing system? And there was famously a couple of financial panics, and one in the late 19th century and one in the early part of the 20th century. Can you elaborate?
Sure. So again, the basic story of, like, again, it's interesting, like, in terms of the descriptions. In the 1800s, they used to call them financial panics, right? And then actually during then they started calling them depressions. Like, so to us, the word depression means, oh, that's an awful economy. But to them, that was more of a euphemism, right? Like, it's better to have a depressed economy rather than a financial panic. You see what I'm saying? So even that with the time was like the PR wordsmithing to try to make people not as scared. And then, of course, since then, the reason we don't have depressions anymore is because now we just call them recessions, right? And so I'm just showing the evolution over time. So back in the late 1800s, it was, the term they used was a financial panic to describe, what we think of as, the economy crashed and unemployment spiked and, business liquidity dried up. And so, one of the characteristics of that, again, given how relatively powerful the private banks were at that time, right? So again, after Andrew Jackson famously kills the second bank of the United States, there was no central bank or anything even like it in the United States, right? It was just banking per se was conducted by, some banks were bigger than others and there were state charters and things like that, but there was no central bank that was overseeing it all. And so what would happen in a typical financial panic, just like nowadays too, is, there would be firms that would be solvent but illiquid, right? Like, in terms, their assets were higher than their liabilities, but they owe people money and they don't have it. Their cash flow isn't there. And so normally, you would just go to the markets and you'd get, but if there's a panic on and everybody's seized up and nobody's, lending, then you get into trouble. And so what happened there, of course, is, businesses would go hat in hand to the private bankers and the ones that had foreseen the crisis and made sure their ducks were in a row. And so that they were liquid when the crash happens. Now they're in a very strong position and they can just pick and choose and decide which businesses are going to live and which ones are going to go under. And in particular, that happened in the panic of 1907. And so there was, so the caricature is that, JP Morgan just, single-handedly had the authority to decide which businesses were going to stay in business or not. And so there was this growing chorus of criticism and people saying, this is a crazy system. We have one guy or one firm shouldn't have this much power with these recurring crises. And then they were pointing to, look at England's got the Bank of England that's been around for centuries. And there's the Banque de France and there's the Bundesbank. And, all the cool kids have central banks and part of their function. It was funny back then. They didn't so much bill it as we got to maintain high employment the way now when people say, what's the job of the Fed? That's one of the, and then to also try to like keep inflation tolerable. That's kind of like the dual mandate of the Fed nowadays. But back then, what they thought the role of a central bank would be is to be a lender of last resort. Like that was an important thing that they said, and to do so like in the public interest, right? In other words, to try to keep it above the fray and not just have narrow, business interests or conflicts of interest, deciding who gets credit or not. So that was part of the course. Now there's a whole literature on this, and I just want to, acknowledge to your listeners, if they are interested and they dive into this genre, there is some pretty like far out stuff, as you can imagine, to talk about bankers funding wars and things like this. But it is undisputed that the actual founding of the Fed. So after the 1907 crisis, again, it really rose a lot more and more people were saying this is intolerable. We need to have a central bank in the U.S. like all the other major powers do. This is so anachronistic. And like a German-born financier, this guy Warburg, he wrote like a big op-ed piece making the case that the U.S. needs a bank, a central bank to handle these important matters. It's, there's anarchy in the system and that kind of thing. And so there was this famous meeting at Jekyll Island, and it was, Warburg, and then there was just lots of a few U.S. officials and private sector bankers who went down to this, exclusive. It was arguably the most exotic in terms of like posh, set apart, elite club, private club on earth at the time, and such was the secrecy they used. And again, this stuff is all like the Fed openly acknowledges this. Like people go to the Federal Reserve's own website to look at the history of the Fed. Like these are essays written by their own people. This isn't conspiracy stuff.
For people who don't know, Jekyll Island, it's located in Georgia.
Yes.
About halfway between Savannah and Jacksonville, Florida. It's a very beautiful area still.
Oh, yeah.
It's a great resort.
Right. And so, anyway, so they went down there, and they even did things like, because a lot of these guys were based in New York, they got on the train in New Jersey just to kind of throw off suspicion and just use their first names because they didn't want the press or anybody getting wind of, why are all these important people all get in the same train car and stuff. And they went down there, and officially it was billed as like a hunting expedition, or, you know what I mean? Like and there is where they hammered out the main elements of what later would be the Federal Reserve Act, which was passed in late 1913. So that's everybody acknowledges it. And they didn't even talk about that that meeting's existence was not even publicly disclosed until the 1930s. So even right there, it's, acknowledging that if the public knew the people that were involved in crafting this legislation, they might not have supported it. So we got to keep it secret. So anyway, even from the get-go, the founding of the Fed, there was a lot of dubious circumstances involved where
was Teddy Roosevelt and the U.S. government aware of what was going on?
I don't know exactly what he knew at the time, so I can't answer that.
Okay, but this is a group of private bankers that did this on their own.
No, there was Morgenthau was somebody I can here. Let me see. No, there were a few U.S. government officials as well, okay. but no, it was like this.
He was the Secretary of the Treasury,
right, and then there was a senator too.
Question for you, Bob, just to circle back to it, because you had talked about the function of the central bank and how it is supposed to be the lender of last resort, essentially providing a financial backstop to the U.S. economy, or to the financial system, I should say. That terminology, can you provide the exact definition of it? Because I think that terminology over time has been grossly misconstrued and exaggerated, sure. And changed, actually, and as a matter of fact, in order to suit the purpose of whoever the current Federal Reserve Chairman is to deal with the current financial circumstances.
Right. So the original, like, so this guy, Walter Bagehot, the way he spelled his name, it looks like it's Bagehot, like it's Bagehot, but I'm pretty sure you say it Bagehot. So he was a guy in the 1800s who wrote like what's considered to be like the classic, defining guidance for how central banks ought to work in market economies. And his dictum, this might not be exact quote, but this is definitely the spirit of it, was to say, yes, in times of crisis, the central bank's job is to lend freely, but at a high rate of discount, or I think he might have said it at a penalty rate. And so the idea was, again, that what the central bank he thought was supposed to do, its role was you wanted businesses that were solvent but illiquid to survive, right? That if it was fundamentally the business model is just, they have a cash crunch. Those are the ones that he wanted the central bank to come in and rescue, just to rescue is not even the right word, but just to get them through the crunch.
To grease the skids, essentially.
Yeah, but the point was that's why I had to charge a high rate of discount, right? So in other words, not to give them low interest rate loans, but to say, no, to charge what in normal times would be considered like, why are you charging me so much for this short-term loan? And the point was that would weed out the wheat from the chaff, right? That the businesses that were really good long-term prospects and just, we need cash for 3 months to get through this rough patch, they would be willing to borrow at the high rate and just suck it up and pay the interest because they knew they could pay the loan back pretty soon. Whereas the ones that they really should just go under, they were like formed during the bubble and they were kind of a crazy model and they just thought, well, maybe this will take off. And then once once the panic sets in, they're in trouble too, obviously. Those are the ones that should go under. And so, then seeing the high rate, they're not going to just keep limping along. That's just going to, further be the nail in the coffin. So that was his guidance. And so what central banks, not just the Fed, but around the world certainly did, like in the 2008 crisis. And then, recently with COVID and everything now, and we can talk about this too, like during the Great Depression, they did this as well. They completely ignored that advice. Now, when people think of a lender of last resort, it's, any big firm that would be painful if they went under, they go to the Fed or the ECB or whatever, and they can get basically a 0% loan. Or if they have what's called toxic assets, maybe the central bank can just buy them at par and cover up the fact that they made bad investment decisions earlier.
Sweep it under the rug.
So it's the exact opposite where, they're like, those are bailouts. That's the central bank covering the sins that were made during, the crazy bubble years of private sector actors and letting them kind of, reset their balances. Whereas that's not what the presentation or the rationale was for, when the Fed was established at that point to say act as a lender of last resort. Again, they were still harking back to that classical wisdom of, yes, that we're only the firms that really ought to survive, let the other ones go under.
So theoretically,
it sounds like Michael Milken and high yield bonds.
Yeah.
So theoretically, you could have a bank that was that basically just faced a run. They're otherwise a solvent bank, and for whatever reason, you get a whole bunch of people who want to come and redeem their holdings simultaneously. According to Walter Bagehot, it would make sense at that point or Bagehot, sorry. It would make sense for them to step in, or the central bank to step in at that point and say, okay, you're facing a short-term liquidity crisis. Your fundamentals are still sound. Here's some cash flow to help get you through this short-term run that you're facing. Then once things stabilize, you have to pay back. And is that the correct interpretation, the correct application of that?
Yes. Yeah. So to be clear, like in the panic of 1907, it wasn't just other banks. It was just businesses in general that were going to JP Morgan that, needed liquidity.
Right.
I'm not sure, to be honest, now that I'm bringing that up, I don't know when they founded the Fed, if they thought the central bank would be lending to conventional businesses or just, to regular banks who would then funnel it through to the business. But to answer your question, right, that because of that practice that I mentioned earlier of, fractional reserve banking, where people have checking accounts and it's not like the bank just puts the currency in the vault with your name on it, that, the banking, modern banking per se, its business model, there's a fundamental maturity mismatch where they borrow short and lend long. By its very nature, yes, if people want to call the loan, if that's the way you want to classify it, the banks are going to be in trouble. And so you're right, Alex, that old school wisdom, like Bagehot's model, would be to say, yes, if there's a bank and their assets are fine, they took checking account balances and they made 30-year mortgage loans to people, and those people are current with their mortgage. That's fine. It's not like there's a housing crisis or something. No, everyone's thing's fine. our books are solid. We still have shareholder equity. It's just, oops, a bunch of the public wants their money. And if we say we don't have it, that will be a cause of panic and be a self-fulfilling prophecy. Then everyone's going to want it and we're done. And so, yes, for a bank like that, Badgett would say the central bank should come in and give them as much currency as they need to satisfy the public who want. And then when the public sees like, oh yeah, there was like a bunch of people who wanted to pull their money out, but that bank just paid everybody, at par, no delays, that would reassure people. So they would stop running on that bank. You know what I mean? And so that would solve the problem. And then, like you say, when panic subsides and people put their money back in the banks, they can pay back the central bank and everything is fine. Whereas if there's a bank that is in trouble because they made a bunch of loans that blew up in their face, or like the farmers, defaulted on their mortgage payments or whatever because crop prices are bad, and now that bank is, illiquid insolvent, bankrupt, then yeah, the central bank's not supposed to give them money. They just need to go down and, and maybe there could be a separate program to make whole the depositors, but that bank needs to go down, that they were mismanaging funds. We don't want them to stay in business. That was the mentality back then.
Right. Okay.
This reminds me a lot of the plot in It's a Wonderful Life and Mr. Potter acting as the central bank there.
Right. Exactly. Yeah. And like you say that, when they go in and, try to get their money, well, I don't have your money. I gave it to Mary. And so on. Like that's
that was very good.
Thank you. I try to work that in whenever I can.
So just getting back quickly to the late 19th century, early 20th century, was J.P. Morgan a villain or a hero during that period, and what he did in terms of stabilizing the economy?
Okay, so here and on this stuff, I'm not holding myself up as an economic historian, so I'm, I don't. If you push me further, I'm going to just have to say I don't know enough of the details, but my assessment as an Austrian economist and as a, adherent to libertarian political philosophy and, that kind of worldview, in terms of what we just have talked about thus far, I think he's a hero, right? That who better to determine which businesses make sense and that, oh yes, I think I do want to give, $800,000 to this business, but not to this one over here, is the person whose own money is on the line. Right. Like that's because if they give it to the wrong, if they quote bail out the wrong firm that just limps along a little bit where they still go under, then, that I would say that's the firm that should have gone under. Right. I guess the big picture is, as an Austrian economist, mistakes are made during the boom or the bubble years. Right. It's not just that, when there's when the economy tanks, we should just do whatever needs to be done to keep everybody going back to the same jobs day after day. It's like, no, right. I would argue some jobs are incorrect. Like some workers have been going to the wrong places Monday through Friday during the boom years, and they need to be laid off. That's the way in a free society you get workers to go where they need to go, because you're not, it's not communism. You're not just ordering them where to go. They need to, if there's a certain firm that should not be in business, that they're using society's scarce resources in an ineffective way, it needs to go under, it needs to fail. That's how it works in a market economy.
It's like diagnosing somebody with cancer. You find out they have cancer, and instead of, saying, okay, we need to either, amputate the cancerous tumor that you have in your body, or, use some sort of radiation treatment to try and kill the cancer cells that exist, they just inject the person with morphine or some other narcotic and say, okay, go on. You feel better now, don't you? And they continue to go on, but the cancer still persists. The cancer is still in the system. And so the underlying issue has not been alleviated, has not been remedied. It is just continuing in a rather sedated state. And so once you eventually run out of the narcotics, eventually you're going to still have to deal with the reality of there's still cancer in the system, and that cancer needs to be rooted out and eliminated.
Yeah. Another medical analogy people use a lot is like a hangover, right? That you're on a drinking binge, and then you stop, and then you're going to have a hangover. It's going to be painful with the withdrawal, but if you could just get through it, you're fine. Where you say, oh, why don't you have some more of the drink? Or, someone who's addicted to heroin, if you just go cold turkey, that will be painful, but that's the path to genuine recovery. Whereas just give you another dose to ease the pain. Like in Austrians' view, that's when the central bank comes in and just injects more liquidity willy nilly. They're just fueling the problem. So John, to answer your question, so in terms of that issue of him picking winners and losers in 1907 with his own money, or his firm's, his investors' own money, I think that's good, and that is something, an important role in the market economy. And the reason he's in that position, why was it him and not somebody else, is because he had demonstrated past proficiency in assessing markets and, being able to see the future better than others could. So that's the kind of person you do want making those judgment calls. Whereas public officials, even if they're working for the central bank, they don't have skin in the game.
Well, that's exactly my point. Is the private sector stepped in. There was no taxpayer money involved in the process. Right. And that's essentially what you want in general to happen in any market situation that's developing, is you want the private sector to handle it rather than reaching out, taking money out of the pockets of taxpayers, and then deciding, even though it's not your money, deciding winners and losers. So that's why I brought that up.
But in general, if you're saying, oh, so do you love the quote robber barons and stuff? It's funny for the reason that the public hates those guys like John Rockefeller and things like. I actually tend to like them, Andrew Carnegie and so forth. But then once they a lot of those guys, once they amass their fortune, then they put in place behind the scenes setting up, schools that would teach these things and just doing stuff like J.P. Morgan. We don't know for sure, but we think that if they had to guess, who is a member at the Jekyll Island resort that invited those guys down, some people think it might have been him. He wasn't at the meeting, to be clear, but they think it might have been they were there under his account or membership. So
Rockefeller creating the Western medicine system in order to create a market for his pharmaceutical products.
Yeah, things, and also too, this again, it's very counterintuitive. At first, you think these rich, multi-millionaires or even billionaires, depending what date you're looking at, who you're talking about, they must hate taxes, right? And no, there are people who make the case that some of those mega rich people were also in favor of the federal income tax because they already had their fortunes and they could put it in tax advantage vehicles and things like that. Whereas their competitors would be the people who weren't yet multimillionaires. And so how do you kneecap them is you have a steep progressive income tax to kind of keep people from catching you when you set up, dynasties and trusts and things that escape taxation. So anyway, that's my long-winded way, John, of saying for what he did in 1907, I think that's great. And that's what you want people in the free market to do. Him more generally, I think he was dabbling in a lot of nefarious stuff, but again, because he was turning to the government to restrict his competitors.
Right. Okay. So let's move into the 1920s then. So we're in the post-World War I era. There was a recession in the early 1920s. What were the causes and policy responses that occurred in the 1920-21 recession?
Sure. And so here, I'm just cribbing a little bit. If people want to Google Robert Murphy, the depression you've never heard of, I have given a public talks on this, and there's an article at the Foundation for Economic Education on this stuff if they want to see some of these statistics all spelled out. But there was World War I. And so incidentally, notice that's one of the critiques of central banks to people who are skeptical of broad government power is that central banks finance major wars, right? So the World War I and II could not have happened if you didn't have central banks kind of fueling the inflation to quote, pay for those wars. And so in the US, the Federal Reserve, because the Fed is formed in late 1913 or authorized in late 1913. It's up and running in 1914. The U.S. eventually joins World War I, and the Fed buys a bunch of government debt, right? And so that kind of monetizes what at the time were unprecedented deficits from the U.S. government. So the U.S. government runs up a huge debt. There's large price inflation. They had price controls and whatever, but there's a lot of simmering demand that they're clamping down. And so what do? The Fed jacks up interest rates and restricts the money supply at what at the time were unprecedented levels. And so that causes a big crash. Prices collapse in the U.S. from 1920 to 21. And there's officially, it's called the Depression of 1920 to 21. But a lot of people never even heard of that because the federal government didn't really do anything, right? It just kind of set back. And that's typically what the federal government had done all throughout U.S. history. When we had these recurring crises or panics, it was a brief period of the markets are bad. But then what would happen, and this happened in 1920, 21, yes, prices fell, but so did wage rates. And so, yeah, unemployment went up a little bit, but it spiked, I should say, but then it dropped rapidly because if you're a business, it's not so much just what's the price that you sell your product for, it's what's the price compared to your costs of, your inputs. And so if if wage rates are coming, money, nominal terms, right? If labor is getting cheaper along with, agricultural goods and other commodities and things, you can still afford to hire workers. Right. It's a business. And so that's why they quickly got through that. And then you had what went on to what's called the Roaring 20s, right? It was like a period of great economic expansion in the United States. So that's what happened, that there was the wartime inflation. They realized that, the U.S. was still on the classical gold standard. And so they realized we have to basically sop up these dollars that we printed to finance the war effort. And so that caused a crash. But
so the system was functioning as it was intended. And when I say the system of laissez-faire, government stays out of the affairs and just lets the private sector handle things.
Right. It's hard to classify this stuff whenever you look at history. You can't just like put boxes on things, but I think it's safe to say that even as of 1921, people still thought of government. Well, here's another illustration of that. So the U.S. ran up a huge debt during World War I, and then once Calvin Coolidge became president later, he ran a budget surplus in every year, right? And so they were so the idea was they viewed governments as like large corporations, and yeah, you can borrow for one-off emergencies, we got to go fight a world war, but then just like a household or even a large corporation, if you have an unusually high period of debt issuance, you then need to run surpluses after that to kind of get back to equilibrium. So it's the same thing here. They weren't thinking in terms of promoting macroeconomic stability. And even the Federal Reserve officials, when you look at their, the minutes of their meetings and whatever, it's clear that early on, they didn't understand what they were doing. They really just thought of themselves as a bank, just like when regular bankers get together and decide, well, we got these applications for mortgages and should we grant this project or whatever. They're not thinking in terms of what will this do to the macro economy. And so the Fed officials also, they didn't fully realize the implications of their decisions, early on. It was only later that they started to really. So John, that's my long way of answering that yes, back then, people did not think it was the job of the federal government to provide, counter-cyclical macroeconomic policies. It was just, we ran up a huge debt, so we gotta tighten our belts. We gotta cut spending. Here's an example from I jotted it down. From fiscal year 1919 to 1920, the U.S. government cut the budget 65% in 1 year. And so nowadays they would never do that, among other reasons, because they would say that'll crash the economy. We can't, you know what I mean? Whereas back then it was just like, well, yeah, we ran up a debt. So what do? You cut spending when you run up a debt.
Right. Just like a household.
Right. Yeah. Right.
And my understanding in the early 20th century that the size of government relative to GDP was something like 6%.
Oh, right. Yeah, it was very low, which is why, incidentally, when Trump nowadays, when he was pushing his tariffs and pointing back at the era when a lot of federal revenue in the U.S. was raised through tariffs as a golden age, he didn't say anything that was wrong, but it was kind of misleading because, back then the federal government didn't spend very much, so you could get by just with having tariffs. So,
right. So let's move then to progressing through the 1920s. How did the economy and the markets get inflated as we approach the 1929 crash?
Sure. And so here, again, if you want to see the more scholarly, in-depth treatment is Murray Rothbard's book, America's Great Depression, where, again, if people like this framework that I'm providing, that, he fills that in with all the statistics and whatnot during the 20s to lead up to the crash in 29. I have a more pop book if people want to see more the politically incorrect guide to the Great Depression and the New Deal, where I, do some of the highlights of this stuff. But
it's being delivered by Amazon to my door tomorrow.
Oh, okay. Very good. So Alex, the quick answer is, again, Calvin Coolidge eventually takes over he was the vice president, gets sworn in as president, and he's a very laissez-faire guy. There's some great quotes from him.
Calvin.
Yes. Yeah. They call him Silent Cal. There's all kinds of funny stories. Some of them might be apocryphal. He was Silent Cal was his nickname. Yeah. He was a man of few words. And apparently at some cocktail party, some woman goes up to him and says, I bet my friend $50 that I could get you to say more than 2 words to me. And he says, you lose, and walks away. So,
I love that story.
Yeah. So anyway, So and it really was, like I said, I think it was every single year that he was president, they ran a budget surplus, just, knocking down the debt that he inherited from World War I. Also famously, that Andrew Mellon was the Treasury Secretary and pushed through tax cuts, right? And like a lot of, like Arthur Lafford, a lot of supply side people say like, oh, this guy is our hero. He was doing, he was onto this way back in the 1920s. And if you go and look at the case too, it was very like he realized that, because part of the story, sorry guys, is during World War I, the new federal income tax, which was, also brought in, I think
Temporary.
in 1913. Yeah. Right. When, the same time the Fed came in is also when they brought in the federal income tax, that the top rate soared to like 91% or something crazy. You know what I mean? Like it went way up. And so Mellon was making the case early on in the 20s that he's saying, this is just keeping people in, tax-free bonds and stuff like that. No, you want entrepreneurs investing in, growth enterprises and things. And so he they had some large tax rate reductions, and that helped fuel, I would say, the genuine prosperity of the 20s. But then what ended up happening is, I'll try to tell the very quick version. During World War I, all the major belligerents except the U.S. went off the classical gold standard, right? So going into the war, every currency, the French franc, the German mark, the British pound, the U.S. dollar, were all defined as a specific weight of gold. And so that implied, certain exchange ratios between them in terms of like what's the natural anchor amount. So it was like $4.86 of U.S. would trade for one British pound based on what you could turn them in. And because if the market rate in the Forex markets moved too much away from that, there'd be an arbitrage opportunity. You would just turn your pounds or dollars into the central banks or to the authorities in the U.S., get the gold, ship it across the ocean, and then, So that's what would keep those rates within a narrow band around the anchor points. But during World War I, all the powers except the U.S. just abandoned that and said, we're not redeeming our currencies for gold right now because there's a war on. And so what happened is the British government printed up a bunch of pounds, as you can imagine. So the dollar pound, parity, the pound was much weaker compared to the dollar. But once the war's over in the 20s, the British government wants to, because remember, they had been the global empire, London's the financial center of the world before World War I. So they wanted to, again, reassert their dominance and reassure everybody that, no, we're still on top. So they wanted to get back to the pre-war parity, that they wanted the dollar and the pound to get to exchange again at that same rate, but they'd printed too many pounds. And so they realized if we just restore convertibility right now, there's no way, the pound has been devalued. So they were engaged in deflation, right? That caused a lot of trouble with labor unions and stuff in the UK. But British officials came and talked to Federal Reserve officials like 1925, I think, 1926, and convinced them. They said, you got to help us out. You need to inflate. In other words, we're shrinking the stockpile of pounds. We're tightening, but we have such a gap between the pound and the dollar. If we're trying to get back to, what was the case before World War I, we need you to help us out. We need you to print more dollars, basically. And so the Fed agreed. And so they had a looser policy. And then that's when you can see like the stock market boom in the US. There's a real estate bubble too, kick off, 26 through 29. So that's partly, again, consistent with this Austrian message that it's not just markets are just, and all of a sudden we have these crazy booms for no reason because of animal spirit. No, there's definite government and central bank policies that dovetail with what happens when there's irrational exuberance.
So Bob, it was not unfettered capitalism that brought about the great market crash. It was an intentional policy by central authority figures in the US and UK to inflate the American system, which created the bubbles in real estate and stock prices in the 1920s. Am I correct?
Yes, that's what. So obviously, it's not that the officials in 1925 and 26, the Fed thought, let's blow up a stock bubble. But yes, it was.
No, but it was it was a consequence of their decision making.
Yes, they consciously decided to ease, and it wasn't even for U.S. interest. It was because they realized the British were in a tough spot, and so they thought, okay, we're going to do because if they didn't do that, like the gold would have flowed out of Britain into the U.S. vaults, and so they realized we need to be more liberal in our monetary policy to prevent that from happening. And
If my memory serves me correctly, Joseph Kennedy, the father of John F. Kennedy, was the U.S. ambassador to the U.K. at the time, and he would have been well connected with these individuals, which resulted in him anticipating the subsequent contraction in money supply, and so he bailed out of the market before it crashed. Do you have any information on that?
I have read a bunch of things on that, and that's why I was again saying to your listeners at the start of this, when you get into this genre of stuff, there's all kinds of allegations, and a lot of the people think that there's this Anglo-American alliance of international cosmopolitan types who don't have, loyalties to one country or the other, and it's sort of this elite club that intermingle, and yes, that they have access to information before the masses do, and they make sure that they're positioned accordingly. So I can't independently confirm everything you just said, but that's definitely consistent with the things I've read about, what's going on at this time. Okay. And again, nobody disputes the stuff I've said thus far. I'm trying to just say stuff that is, airtight, that anybody, acknowledge stipulated facts. But in terms of what else were they thinking of when they made those decisions, and do they tip people off? I'm sure stuff like that happened as well.
Who said the famous quote, "The tragedy of unintended consequences," or something to that effect? I don't remember who exactly said it, but that's what it kind of comes back to when we talk about, the deliberate choice to move or to inflate essentially the American economy and the British economy in order to prevent the transfer of all of that physical gold. But I think this is a great place to pause here, because we're now going to get into the Great Depression, because as everybody knows, or as the public is led to believe, that bursting of the bubble is what leads to is the catalyst for the Great Depression. But we'll pick it back up on the other side of the break after Bill runs us out here.
Alexander, it was a gentleman named Richard Jekyll who made that quote famous: "The law of unintended consequences pushes us ceaselessly through the years, permitting no pause for perspective."
And there you go.
And there you go.
All right, Bill.
This is a fascinating conversation, Alex. You typically hear, well, let's do this really, really quickly. One, I want to encourage people to stay tuned, because there's a lot more of this conversation to follow. So part 2 comes after this one. Okay. But Bob, before we get out of here on this episode, just remind people how they can get in touch with you and where they can find out more about what you're talking about, so that if they're so inclined in between episodes, they can do so.
Sure. On Twitter, I'm at Bob Murphy Econ. So that's where that's kind of like the clearinghouse where I post stuff I'm doing. Also, probably my personal podcast is a place you could go to get a lot of this stuff. That's at bobmurphyshow.com. And I'm also chief economist at Infinio. So that's infinio.ai is where I'd point people.
That's great. Alex, remind people how they can get a hold of y'all if they want to reach out.
Absolutely. They can reach out to us at info@medwealth.ca. That's info@med-wealth.ca.
And for those of you listening, do not forget, to mark yourself as a follower, please. Because the beauty of that is, if you become a subscriber and you're not one already, you will be notified when this next podcast drops. All the subscribers are going to know when part 2 of this drops. You want to be a subscriber at that point. I would also encourage you that if you find this conversation interesting and informative, tell people about it, okay? Because word of mouth promotion is great. And it is a really effective tool of promotion. So until we get to part 2 and what really happened, not what you think happened, and not what a lot of people will tell you happened as a result of tariffs, a word very much in currency today. Stick around. Come back. On behalf of John, Alex, and everybody at MedWealth, I want to thank you for taking the time to listen, and we'll catch you on part 2. Thanks.
Thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of IPC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.